It's going to be Liberation Day in America, and it's going to be a day that hopefully you're going to look back in years to come and you're going to say, you know, he was right. This has turned out to be one of the most important days in the history of our country.
President Trump there imposing tariffs on all U.S. trading partners worldwide, his biggest assault yet on what he calls an unfair economic system. The escalation threatening to upend global supply chains and stoke inflation.
Asian nations hit hardest. China now facing 54% total levies ahead of Taiwan, Vietnam and Japan. Australia and New Zealand already saying they will not retaliate.
Markets in tariff turmoil as U.S. stock futures tumble along with oil while bonds gain. Apple shares plunging in late trade. Asian investors now bracing for a heavy sell-off. This is the Asia Trade. I'm Haidi Stroud-Watts in Sydney along with Paul Allen, and let's get you straight to that market turmoil that we are very much bracing for. For a moment there when we saw the sort of trading volatility in US markets, there was a point in the session where there was sort of almost a tepid hope that this was not going to be as bad as expected. Perhaps in a sense it could have been worse, but certainly these tariffs that were announced by President Trump, an average of 22%. If you want to compare to last year, it's more around 2%. It has sort of materialized in terms of some of those worst case scenarios. Take a look at how we're opening up just the first few minutes of the staggered session here in Sydney. The ASX 200 down by about 0.4%. We'll get a better read as those stocks sort of get online over the next hour. But certainly in a lot of ways, Aussie stocks have been seen as a defensive play. So we could see perhaps a little bit more sheltering, even though Australia has been one of the countries that's already come out and said that there would be no retaliatory tariffs being applied. Chicago and UK futures look at that steep decline of over 4%. We're also watching currencies, dollar yen hovering at that 148 level. Expectation is for the dollar to move higher, but we have really seen that being expressed when it comes to dollar China, already above 734 in the early Thursday action. That would put it above that intraday limit set for dollar China on Wednesday. So really in that sort of discomfort zone for the PBOC. We're watching, Paul, to see how Chinese authorities, the PBOC and other regulators respond to all of this.
Well, let's take a look at how US futures are trading. When trading began in futures, they went sharply south and have been heading that way ever since. We've got S&P E-minis now off by just a shade under 3.4%. Crude prices also falling, this reflecting demand fears. We've also seen US crude inventories rising now to the highest level since July, and energy markets more broadly falling after that announcement. Benchmark gasoline futures in the US also falling more than 3%. One thing that's rising, there it is on the screen, no surprise there, the gold price continuing to push ever higher, now just below the 3,150 an ounce. Well, joining us now in Washington is Bloomberg Balance of Power co-anchor Kayleigh Lyons, and in Hong Kong, our Chief North Asia correspondent Stephen Engel. Kayleigh, I want to start with you. You did speak to the Treasury Secretary Scott Bessent. I believe he warned on retaliation. What sort of retaliation is the US potentially expecting, and is this the end of the tariff story?
Well, no, it certainly is not the end of the tariff story, Paul, even though we finally did get this long-awaited announcement, a 10% blanket rate on all U.S. trading partners that will go into effect at midnight on Saturday in the U.S. That would be April 5th. And then additional reciprocal rates charged to countries that the White House is dubbing worst offenders that will go into effect on April 9th. Those numbers including China, which would have a 34% rate on top of the 20% that's already in place, 20% for EU, high numbers as well for Vietnam, which is at 46%, 25% on South Korea. Obviously, all of these countries we're going to be watching for their responses to this. What President Trump said from the Rose Garden today is that what he's hoping countries will do if they want exemptions to these levies is lower their barriers to trade, not just tariffs, but non-tariff barriers as well. He is hoping the rates will come down and that is what will result from this, not retaliation. And that was the message that was echoed by Treasury Secretary Scott Bessent when he joined a special extended edition of Balance of Power earlier. This is what he told our colleague Anne-Marie Horder.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation.
I would note, though, that while this may be the numbers for reciprocal tariffs, White House officials also told reporters today that additional tariffs do not necessarily end with today's announcement, suggesting tariffs on sectors, be it critical minerals or pharmaceuticals, even lumber, could still be coming shortly.
And Steve, we've seen additional sort of pressure really hit hard when it comes to Asian economies like Cambodia, Vietnam, China, if you take a look at cumulatively where we're at for those tariffs on Beijing now.
Yeah, absolutely. This is a seismic day for, you could say, globalization for sure, and Asia Pacific is taking the brunt of these increases from U.S. tariffs. Let me just put it very succinctly. We've already piecemeal looked at certain countries, but let me run down the list. Taiwan, 32%, Japan, 24%, India, 26%, China, 34%, Vietnam, 46%, South Korea, 25%, Cambodia, 49%, Malaysia, 24%, Thailand, 36%, Indonesia, 32%, Australia, yes, 10%. We already heard from Anthony Albanese saying this is no way to treat a friend, and called it unjustified as well, 10%. And he also pointed out that Australia does not tariff U.S. products in kind. So it's going to be a fascinating day today as Asia gets to react essentially first globally. And these are the nations that took it the hardest, obviously. We're still going to be awaiting any kind of news from Beijing as it wakes up to this reality. I'm sure all the top policy leaders were up looking at this press conference, as we were as well here in Hong Kong, and seeing that it was perhaps even more severe than what Bloomberg Economics pointed out a couple of days ago, saying if there were 20% additional on top of the previous 20%, that would be the most severe case scenario. Well, now it's 34% on top of the 20, bringing it to a cumulative, according to Scott Bessent in that interview with Anne-Marie Hordern, of 54%. So probably a worst-case scenario for China. How do they respond? There was some state media articles yesterday trying to appeal for calm. We do know that over the last week, top executives from around the world, including Tim Cook from Apple, were in Beijing, meeting Xi Jinping, meeting Li Qiang, trying to get the message from them that China is open for business. But keep in mind, a company like Apple, I'll just use that as an example, their three main overseas production bases are China, India, and Vietnam. Those three countries, China 34%, now up to 54% tariffs. India 26%, Vietnam 46%. So it's going to be a tough one for big multinational companies to adjust their supply chains, no doubt. Doesn't happen overnight.
You know, and as markets continue to pass this, you continue to see gold as being one of the standout hedges, right? Spot gold at the moment rising to a record above $3,150 after the tariffs were announced. We know that this has been one of the top performers. We've seen, about a 20% rally so far in the first 3 months, at best quarter since 1986, I believe. So continuing to watch some of those haven assets throughout the course of the Asian session. But Kaylee, when it comes to neighbours, Mexico, Canada, what did we see? There was sort of a little bit of, respite. But we're still hearing from Mark Carney that reciprocal moves will be coming.
Yeah, interesting to not see Canada or Mexico on the list that the White House sent out in terms of who is facing these reciprocal tariffs. They, in fact, will not be subject to this regime. Instead, what the White House is leaving in place is the fentanyl regime, which, of course, already happened earlier in this administration. The 25% tariffs on all imports from Mexico and Canada, the president said, were emergency economic powers being used because of what was coming over the border with the United States. There was an exemption carve-out for goods that were compliant with the USMCA trade agreement, and that all still stands. So there was no real escalation in terms of what Mexico or Canada are facing here. I actually spoke earlier with the Premier of Ontario, Doug Ford, who said he would suggest to Mark Carney that because of that, Canada not retaliate. But as you alluded to, Heidi, it does seem that Mark Carney is still indicating there will be a response of some kind from Canada. And we are expecting we'll hear more from the Mexican president as well, Claudia Sheinbaum, when she has her daily briefing with the press tomorrow morning. We'll see if she has any kind of reaction as well. But if anyone was spared from the activity today, or if anyone can read today's announcement as good news, relatively speaking, Mexico and Canada do seem to have been the only ones really who have caught a break here.
Steve, you were talking about China earlier and potential retaliation. I'm sure policymakers saw this coming or something like it. What could potentially be announced later on today?
Well, you mean announced from Beijing? Well, obviously, they've kept kind of their response so far to the 20%, 10 plus 10 on the fentanyl issue, as Kayleigh just mentioned, fairly muted. They want to keep a number of levers still at their disposal. They wanted to see how high these tariffs would go. Now that we know that it's a cumulative 54% tariff, China will probably start bringing out some of its retaliatory big guns, if you will. I'm not predicting anything other than to say that they have other tit-for-tat tariffs. They can't do like-for-like because of the distortions in trade, but there can be export restrictions in rare earths and key minerals that China has a dominant position in. They could add U.S. companies to their negative entity list. They could also potentially weaponize the yuan. It's been sort of steady through this tumultuous 2 months of the second Trump administration. Keep in mind, during the first Trump administration, we saw the yuan weaken 11% versus the U.S. dollar over 2 years, a sort of weaponization. They have not done that. Pan Gongsheng at the PBOC has kept the currency fairly stable. We'll have to see going forward. We'll watch the fix later this morning, no doubt. And then again, how do they justify what to do in the face of this USTR report? Finally, we got the details as Donald Trump held it up. The USTR review of the Phase 1 trade deal was not kind to China, essentially saying China fell far short in implementing its commitments to purchase U.S. goods and services. So there's lots to unpack this morning.
Kayleigh, I do wonder, it was interesting, there was not a lot being alluded to when it comes to negotiating these tariffs down. There was a lot of talk about kind of, fundamental restructuring of the U.S. economy. As Scott Bessent said in his interview with us, that if there's no retaliation, then it's not going to get worse. Was there any kind of indication that there would be an opportunity for talks for things to get better?
Yeah, there was. The president said if countries want exemptions, that they should take down their tariff rates. So that are likely the conversations that the White House is going to be engaging in. And we actually heard from the White House press secretary, Caroline Leavitt, about that earlier this week. And she suggested that already leaders were making phone calls to the president, that he is always willing to take phone calls and work on deals. So that does seem to be the prevailing wisdom in Washington, that this is really what the president is trying to achieve, that this is not necessarily the end-all, be-all, that he is hoping that this will result in lower barriers being placed on countries importing goods from the United States. That said, we have also heard from this White House that he does want more manufacturing capacity to be focused in the U.S. He does want more built here, in that he thinks tariffs incentivize this. And he also has had those close to him in his administration touting the revenue-generating capacity the U.S. could have if these tariffs are in place for the longer term. So it remains to be seen what kind of balance the administration is really trying to strike here in terms of trying to secure that revenue as it looks to do things like tax cuts by the end of this year, but also using them as a negotiating tactic, trying to bring countries to the table and work out trade deals that he views, or at least trade policies that he views as more advantageous and fair to the United States.
Our co-anchor of Bloomberg Balance of Power, Kayleigh Lyons there, and Bloomberg's chief North Asia correspondent, Stephen Engel. We'll be speaking live later with the U.S. Commerce Secretary Howard Lutnick following President Trump's so-called Liberation Day tariff rollout. That's coming up on Bloomberg Surveillance at those times on your screen. And coming up on the Asia Trade, we'll be talking about these market navigations around the Trump tariffs with Capital.com and Mizuho Securities. Plus, we'll be asking Morningstar if Nintendo's new Switch 2 console can live up to the hype. Much more ahead. This is Bloomberg.
It is the American people who will pay the biggest price for these unjustified tariffs. This is why our government will not be seeking to impose reciprocal tariffs. We will not join a race to the bottom that leads to higher prices and slower growth. We will stand up for Australia.
Australian Prime Minister Anthony Albanese there. President Trump did single out Australia's refusal to take American beef as one of the reasons for the 10% tariff on Australia. It's important to note there is no tariff on US beef, but it is banned for biosecurity reasons. We take a look at how assets are performing. The ASX reacting as one might expect. We're off by more than 1.8% right now. The Aussie dollar sinking as well. One area of green, though, in Australia is gold miners, and thanks to that weakening currency, gold priced in Aussie dollars now $5,050 an ounce. So silver lining, or a gold one at least. Let's get to Kyle Rodda now, senior market analyst at capital.com. Kyle, I just want to start off with a rather broad question to get your reaction to what was announced today. Was it worse than you expected, or about what you expected?
Well, it was a little bit worse than expected. It certainly could have been worse. There's a few things missing there that mean that, maybe there's some, reason to be optimistic or at least hopeful in the coming days. But effectively, if you do look at what's happened, the absolute level of tariffs is higher than expected. The markets are going to have to price in this growth shock now. And there's still high degrees of ambiguity about what the sort of long-term objective here is for the Trump administration. I mean, is this supposed to be a radical restructuring and shaking up of the global trade order and the global economy? We've seen some indications that maybe they're willing to negotiate with trading partners on certain tariffs. That leaves some wriggle room. On top of that, though, it sort of opens questions about, the reciprocal tariffs in the United States and whether, tariffs can actually be raised from here as, this sort of tit-for-tat dynamic plays out. And on top of that, too, it's really about that certainty dynamic. Is this kind of the end of the most aggressive tariffs? If it's not, well, this is still going to have a serious economic impact. Businesses can't plan, invest, employ. Consumers can't plan either. Market sentiment remains poor, and therefore risk remains skewed to the downside. So certainly, it could have been a lot worse, but I think the markets were hoping for a lot better.
Yeah, and so much to unpack here in terms of stock-specific stories, sector-specific stories as well. We've seen Nike sinking after hours, Apple as well. And US battery makers is an interesting one because pretty much all the graphite needed for batteries comes from China. So their import costs just went up by 50% or more. How do you see this playing out? What's the fallout going to be, and which stocks and which sectors should you be avoiding right now, and where do you go for safety?
Well, this risk is systemic, so as a result, there's really, as far as equities go, very difficult to find places to hide out in. I mean, even gold stocks are liable to be a little bit volatile because we're probably going to see a price shock, sort of rippling across the world, and that's going to, affect the operations of gold miners. More or less, we're looking at an environment which is, to really put it bluntly, these tariffs are sort of more or less being built upon ideological foundations that are spurious at best, if not completely fallacious, or perhaps even bad faith. As a result, this is going to be a growth shock. We're seeing the markets now pricing in a bigger growth shock than previously expected because the level of tariffs on aggregate is much larger. And then we run into this complicated situation where you're also going to get a short-term supply shock, a price shock, which is going to make it maybe more difficult for central banks, for example, to be able to lower rates, to be able to support the economy through, if not a transition, then certainly a period of weaker growth, maybe structurally lower growth. So there's really not many places you can really hide out here from an equity market point of view. I think gold, as far as a trade, remains very, very robust. All the tailwinds are pointing in the right direction at the moment. You can sort of dabble in the currency markets too, although there's a lot of risk there between, the US dollar depreciating because of a weaker growth outlook in the United States versus, a safe haven demand as financial conditions tighten. Obviously, the trade deficit is going to narrow as well. I think the Japanese yen on that basis is still good, but the Japanese economy is going to be hit. Gold's a big trade, short oil's obviously an obvious trade. And going back to the answer before, as long as those uncertainties and those factors continue to play out in terms of trying to work out what the end game is here and what the tit-for-tat dynamic will be, and if there's any further tariffs to come, short equities, that's going to remain the case until some of those stories become a little more crystallised, a little clearer. Then you can maybe start dabbling in. Until then, uncertainty remains high, volatility remains high, risk remains off.
This might be a little bit contrarian, but China typically has been a pretty good diversifier from what's going on in the US. Do you kind of see that logic, or is China and our Chinese equities sort of just another proxy where we'll see that Trump dissatisfaction being expressed even further?
It's sort of a short-term, long-term story there. I think the short-term is going to be a factor of basically pricing in weaker growth across the globe. That's going to impact this kind of nascent recovery that we're seeing in China, albeit one without much momentum behind it. So that's going to have to be discounted into asset prices. I think if we sort of peel back the layers here and sort of maybe even step back a little bit as well, there have been other things to start the year that have kind of either exacerbated moves in the markets or certainly other themes that have been driving things. And if you look at what's actually been happening in China since the start of the year, there's been the DeepSeek developments, which have expanded multiples because all of a sudden the market looks like it might have greater growth prospects, and the sell-off in US tech, which was very rich, saw basically a rotation out of expensive stocks into cheap stocks like that of China's. And we are seeing some green shoots of improving economic activity and greater appetite to boost growth in China in the long term as well. That's going to be welcome. So in the short term, the growth shock has to be priced in. In the long term, there are those sort of bigger macro factors that could drive further appreciation in some of those assets. It depends on how you want to play it. But certainly, again, just on the basis of these tariffs alone, I don't think this is going to be some kind of safe haven bid or rotation play or opportunity to go into China just while all of this plays out.
Australian equities have typically, perhaps not been as compelling and certainly on the expensive end of the spectrum, right? But we've spoken to multiple people recently in light of the changing sort of tariff environment that, are quite liking Australia in terms of being a defensive play. Can you see that?
Not particularly, just on the basis that, we're a small open economy that is going to be very sensitive to these changes in global trade. Obviously, the tariffs aren't going to impact us so much directly. In fact, there's sort of maybe even some spurious argument as to why 10% is applied on us on the basis of the tariff rates that we have on the US alone. But we're going to be impacted by the China story and the weakness there in the short term, the impact on commodity prices and miners. And you've got to remember that, as far as expensive valuations go, the ASX 200 was an egregious example of a market completely overvalued at the start of the year and has only seen multiples kind of come back down to their sort of 10 to 20 year average or close to it really over the last couple of weeks. So I can't see a really compelling case as a safe haven play for ASX 200 stocks. If anything, I think the downside is potentially even greater. And I've only just been able to sort of take a peek at how the markets opened this morning, but it's more or less reflecting that. We're seeing a 1.5–2% drop, which is indicative of a market that's concerned about global growth risks and a stock market that is highly sensitive to global growth.
All right, Kyle Rodda, Senior Market Analyst at Capital.com. Thanks, as always, for joining us with your insights. We've got more ahead on the Asia trade. This is Bloomberg.
Take a look at how US futures are trading at the moment. This is the picture when it comes to really the risk aversion and how we continue to see that haven bid being expressed into global bonds, treasuries, as well as gold. Spot gold hitting that record high just in the last sort of few minutes or so. We're also watching the start of trading in the next half hour in Japan. At the moment, Nikkei futures down about 1,600 points. It could be the worst day that we've seen since that carry trade unwind, that volatility that we saw back in early August. That 35,000 level is now at risk when it comes to the Nikkei. Of course, Japan on its side really preoccupied with the impact of auto tariffs, but we're going to see this expressed in so many different ways across Asia, from US retailers and their suppliers to the broader risk of US recession, how that plays out for these exporting economies. More ahead on the Asia trade. This is Bloomberg.
In a few moments, I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Such horrendous imbalances have devastated our industrial base and put our national security at risk. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles. Nearly a century later, in the face of unrelenting economic warfare, the United States can no longer continue with a policy of unilateral economic surrender. We cannot pay the deficits of Canada, Mexico, and so many other countries. And today we're standing up for the American worker, and we are finally putting America first. And for these reasons, starting tomorrow, the United States will implement reciprocal tariffs on other nations.
President Trump there announcing the US will apply a minimum 10% tariff on all trading partners and additional duties on about 60 nations. Well, steel and aluminium imports already subject to Section 232 tariffs won't be subject to Trump's reciprocal duties. Gold and copper were also cited in the exemption clause, and this seems to indicate that Trump at least gave some leeway for the metals markets that the president has long prioritized in his trade wars. Let's bring in our White House reporter Jennifer Deloley now. Jennifer, does this suggest that there could be some carve-outs if there is a raw material here that the U.S. really needs?
I think it would be perhaps a questionable takeaway, actually, to believe that today. The emphasis coming out of the White House, out of the administration officials today was really, we're not sparing anyone. And you saw that with the fact that they applied this 10% baseline rate to everybody, in addition to targeting, some 60 or so countries with specifically higher rates, reciprocal rates that, stretched into the 40s and even 50% for some countries. Clearly they are at this very early step making some exemptions, but those are really for products that are being hit already by 232 tariffs, like steel, like aluminum, like copper, probably after a trade probe. And then they are making exceptions right out of the bat for energy and energy products as well.
The energy piece is quite interesting, particularly in light of all of the geopolitical uncertainties involving the Trump administration with Russia and some of those threatened sanctions. Have we yet to see the conclusion of that part of the narrative?
I think what some administration officials have said is that this is the beginning of a negotiation process. Clearly, there is an opportunity for countries to negotiate down their individual reciprocal rates. And so, there are products and companies that will also seek to lobby for exemptions or carve-outs. That's certainly going to happen. The opportunity for actually achieving that kind of exemption, it seems fairly limited. I mean, they were very clear-cut, administration officials were today. The president was about wanting to really have this baseline 10% and really force countries to come to the table on their broad tariff barriers to the U.S., both levies and, policies that deter U.S. products from being sold there.
Our Bloomberg White House reporter Jennifer Deloley there. Well, let's get to Deborah Elms, who joins us now for some analysis. She's a head of trade policy at the Hinrich Foundation, of course. Deborah, great to have you with us, particularly on a pretty seismic day like today, right? We've been in brace position for so long. So I'll start off by asking what your sort of initial reaction has been to this announcement.
I think it's worse than expected, and it's particularly worse than expected for most of Asia, where tariffs are now coming as high as in the high 40s. And I think that was certainly unexpected, including on countries like Myanmar, war-torn, least developed, now has an earthquake, just got hit with 44% tariffs, I think. Other countries as well. Vietnam has very high tariffs, Cambodia, even Malaysia has them. And Singapore, of course, on the overall tariff got hit with 10%. I mean, this is, I think, beyond what people anticipated and will be quite damaging for the region.
And you see this as being damaging on a long-term structural basis, right? It was interesting. A lot of the commentary today was around, fundamental restructuring of the U.S. economy. Does this lead to really that longer-term disruption? And what do you see as being the longer-term implications for a region like Asia and for some of these Southeast Asian economies, which alongside China, whatever strategy that seems to be, are suffering some of the heaviest tariffs?
I think what it does do for a lot of firms is confirm or reconfirm that the United States is no longer the market that it was. And so you're going to have to work much harder to find alternative markets, particularly for goods that are produced in and around Asia. So final markets can no longer either be the United States or just be the United States because the costs are simply too high. Very few firms can absorb a 40 or 45% hit to their bottom line, and so they will have to find alternative places to sell goods. And that will lead, I think, in the longer run to very different supply chains manufactured, especially in Asia for Asia. or in Asia increasingly for Europe, or potentially even for the rest of the world. So there will be a fundamental shifting, I think, of how we produce goods and where they get sold going forward.
Deborah, is there any market, though, that can replace the appetite of the U.S. consumer?
Well, I don't think the U.S. consumer is going to have much of an appetite. I mean, this is an enormous cost burden that has just been put down on American consumers as well. So even if you said, okay, it's fine, we'll figure out some way around these tariffs from the Asian side, you have to find an American that's willing to buy your products at 45% more costs than it was a week ago, you know. And I think the consumers and businesses within the United States that are buying imported products are also going to have a sort of gut check moment. How much do they really want those foreign products? And even for products that appear to be domestically produced within the United States, a lot of them have foreign content, raw materials, parts, components, et cetera, that are going to be very hard to replace and very expensive. So I think the American consumer is not the same American consumer that we had even a week ago, because they will be feeling increasingly constrained financially.
Is there an opportunity here for more regional trade alliances that exclude the United States? And I give the example of the CPTPP. China's been trying to gain admission to that for some time. Did the door just open a little bit wider?
I think it's possible, although I think there will be some reluctance by many of the countries in the region, and certainly CPTPP members, to consider moves towards new entrants at this moment. But I think as you go forward in time and as a bit more clarity it sort of evolves around what does this mean for their domestic economies, what does it mean for regional integration, I suspect that we're going to find more coalitions willing to think about things that they never would have thought of before. So one example might be an increasing alliance of some sort between CPTPP and the European Union, which also got hit with 20% tariffs this morning. So I think there's going to be some alternatives that have been potentially on the table but weren't really considered seriously, that are suddenly going to shoot to the top of agendas. And the question now for everyone other than the United States is, well, how enthusiastically do we want to pursue these alternatives? My guess is that for many of them, the answer will increasingly be, we're actually more interested than we thought we would be.
Deborah, there is always the element of, President Trump loves a deal. He's willing to take phone calls, to have these conversations. If he gets what he wants, there might be exemptions. These tariffs might come down. I do wonder, though, how long-lasting do you see that the confidence hit, particularly if we're already seeing everyone from retailers to suppliers to logistics providers and shippers, rejigging their processes and their investments at this point to try and minimize the damage?
Well, tariffs tend to be very sticky. I mean, we still have tariffs in the United States dating back to World War II. So I think once you impose a tariff, it can be very challenging to remove it. And I suspect that you will have to prepare to pay more to access the American market. And the U.S. is clearly counting on a lot of revenue coming in from these tariffs, and they're counting on the amount of damage being caused by imports that will lead to greater investment in the United States manufacturing base. And so all of that combines to suggest this is not a short-term issue. I'm not sure that you can negotiate your way out of it at this point. If you look at how these tariffs appear to have been determined, it's largely about your trade deficit. So if you had a trade deficit, let's just use that as the baseline calculation for reciprocal. That's impossible to fix, right? What you had as a trade deficit, you can't go back in time and undo that. So even if you cut your tariffs to zero, and several countries tried that ahead of this reciprocal tariff announcement, doesn't seem to have made a lot of difference in the final number that they received. We'll see. Countries will try, I'm sure, but we don't have a lot of time before these tariffs start to be applied. And it's not clear that it's going to do you much good, to be honest. And so I don't know how enthusiastically countries will embrace negotiations, especially because the payoff seems to be fairly minimal. Countries that tried it still got hit with reciprocal tariffs.
So does that also mean that perhaps in your view you think that countries that say that they won't reciprocate, so they'll just kind of sit and wait and hope that for Australia, for example, that, you know, that long-standing alliance will eventually come to bear fruit, that that's not really going to be an effective tactic either?
That would be my guess. I mean, you know, even Singapore got hit with 10% this morning. So I think, you know, they have a long-standing free trade agreement with the United States. They have a surplus with the United States. They have all sorts of political and security ties. They have no tariffs applied to any U.S. products, partly because of the FTA, but partly because Singapore is tariff-free. And it still got 10%. So I would say, like, if that doesn't insulate you from the damage, then in my view, I don't know what would. And even if you've got a deal with this administration, I still think, I don't know what the value is of that deal. And you look at Canada and Mexico and you say, well, these are two countries that have had deals in place for decades. They still got hit with tariffs. Not so much on the reciprocal tariffs today, but they still have a 25% tariff in place on the IEEPA discussions. So I'm not certain that a deal protects you, and I'm not certain that a deal is very long lasting. So I don't know how many countries will line up to try to get one for themselves.
All right, Deborah Elms, Head of Trade Policy at Hinrich Foundation. Thanks so much for joining us. And we will speak live later on with U.S. Commerce Secretary Howard Lutnick following President Trump's Liberation Day tariff rollout. That's coming up on Bloomberg Surveillance at the times on your screen. Haidi.
Take a look at how this global bond rally is really faring, given that we have seen this is one of the standout sort of ways to try and get a little bit of protection from this tariff chaos. We've seen Treasury futures surging at the open amid this ongoing demand for haven assets, and that's being reflected through the bid for Aussie, really across the spectrum there, Australia and New Zealand sovereign debt there as well. That announcement of high US tariffs fueling broader concerns over global growth, and we're seeing also, of course, that haven bid being expressed through gold, spot gold hitting to a record, and of course looking like a pretty ugly open ahead for Japan, Paul.
Yeah, let's take a look at how commodity prices are tracking as well. We did have oil continuing to extend its move lower, now off by about 3%. That move started after the tariff announcement. US crude inventories, meanwhile, have risen to their highest level since July. The iron ore price continuing to fall, still holding on just above $100 per tonne. We've got the pure play iron ore miner in Sydney, Fortescue Metals, off by 3%. Gold, however, unsurprisingly, continues to hit new highs. More ahead on the Asia trade. This is Bloomberg.
Take a look at Japan, or perhaps don't take a look at Japan if your stomach isn't strong enough for the level of that decline that we're expecting. Japanese stocks at this point set to face the worst period since that meltdown over the carry trade unwind back in August. This is the picture as we see a decline of almost 5% when it comes to the unwinding in Nikkei futures. Now, the Topix not looking that much better. The Kospi, when it comes to Korean trading, also looking like we'll see quite a bit of weakness there. We're just about 15 minutes away from the start of trading in those markets. Let's get over to our Bloomberg Asia stocks reporter, Yu-Kyung Lee, who joins us now for a preview of that market reaction following the tariff announcement from the Trump administration. So let's start off with Korea. 25% reciprocal tariffs on South Korea. What are the implications for the market? Which sectors are you watching out in particular?
Sure. So 25% reciprocal tariffs on South Korea, which is one of the most sensitive nations in the world to global trade. We're going to see a huge sell-off and spikes in volatility this morning. And we are already seeing the Kospi futures and Kosdaq futures down almost 4%. And we're definitely going to see across the board a big risk off and spikes in volatility. And in particular, we're going to watch the sectors with the companies that have factories in Vietnam. Now, Vietnam is also facing the reciprocal tariffs of 46%, which is much higher. And there are a lot of fashion apparel companies in South Korea that supply to global brands like Nike and Lululemon and Gap, and they have factory in Vietnam. So they are going to be the ones that probably going to see the big sell-off. We're also expecting some pockets of less relative outperformance in sectors such as cosmetics and defense. And that's because even though the cosmetic sectors also face 25% reciprocal tariffs, they're still cheap compared to their rivals, European rivals. So even though the tariffs may make Korean cosmetics still slightly more expensive, like from like $10 lipstick may become like $13 for the U.S. consumer, that still can be considered cheap. So I think some investors are looking at the cosmetic sector for relative safety. And up next is the defense, which has been performing really well in South Korea. And with this, the free trade, which used to connect the world, is now going to be could be unraveling, and which could be a catalyst for more geopolitical tension. So that could draw more investor bets to the South Korean defense sector. So those will be the sector that we'll be watching this morning.
And I guess we're going to be looking at chip stocks pretty closely as well, because South Korean chip makers have had a pretty good year so far. Does that end now? Is that one of the trades we expect to see unraveling as well?
Yeah, so if you look at the headlines from the White House this morning, semiconductor was one of the few sectors that were exempt from the reciprocal tariff. So that's the good news to the semiconductor investors. But given this presence of the semiconductor companies in the global trade, they may still suffer some sell-off this morning. Although when I checked with investors this morning, the sell-off may not be as great as expected. However, it may be a surprise to a lot of investors that South Korean semiconductor like Samsung and SK Hynix share have been outperforming this year. They're up more than 10% so far, even though there has been a big tech rout in the U.S. in this unraveling of the AI rally. That's because the South Korean chip makers are still going to see some earnings revision, and a lot of investors, including Goldman Sachs, expect their first quarter earnings to exceed expectations. So definitely they are safe from tariffs for now, and earnings going to be up. So that could be some kind of a safer space, if we can call them safe this morning. Although given the exposure to the global trades, they may see some kinds of sell-up as well this morning.
All right, Bloomberg Asia stocks reporter Yu Kyung Lee there. Well, let's get back to the bigger picture now in terms of those tariffs, Heidi, and it really was Asia that took the full force of this. If we take a look at a chart of who got hit, and this is a chart that President Trump actually held up during his press conference. Well, look at that. We got the European Union on there at 20%, but the rest of it is all Asia. China at the top, 54% total. That's including those fentanyl tariffs that were already in place, or the fentanyl-related tariffs. Wells Fargo's offered some commentary on this, saying that this was at the high end of expectations, using the word massive when describing what China has been hit with. Southeast Asia, the currencies in the region, Wells Fargo sees them facing selling pressure. Also, Arup Chatterjee in the long term sees this strengthening the US dollar, fueling inflation and increasing global growth risk as well.
It's interesting because you kind of start to see that maybe it's a China plus one strategy that the US is targeting, right, when it comes to some of these manufacturing bases that were seen as diversifiers away from China, like Cambodia and Vietnam being so heavily hit. But the question for investors is where to hide, right? There's not a great deal of positioning at the moment, but certainly the ones that you can see has really been that classic trifecta of sovereign bonds, treasuries mostly, the yen, as well as gold, spot gold hitting that record high this morning. But take a look at what Goldman sees as its top pick, and they actually see that sort of defensive mechanism being expressed in the yen as a top hedge against US recession, as well as the tariff risks. Goldman's expecting yen to climb to the low 140 levels against the greenback this year. It's been seen with that move to 140 implying a 7% gain from current levels. It is more bullish than the year-end median estimate of 145 in a Bloomberg survey of analysts that we spoke to there as well. But they really see that as the best currency hedge should the chances of a US recession increase. We've already seen the yen really outperforming major peers against the dollar after the tariff announcements, up by about 0.7% there as well. So we continue to see sort of how much further that has to run. Certainly the yen tends to do best when real rates in the US equities are falling in tandem. So we'll be watching for that dynamic very closely. Well, more ahead on these tariffs and how the markets are navigating all of this turmoil here on the Asia Trade. This is Bloomberg.
We're worst of all are the non-monetary restrictions imposed by South Korea, Japan, and very many other nations. Toyota sells 1 million foreign-made automobiles into the United States, and General Motors sells almost none.
Well, there's President Trump there talking about tariffs on Japan and Korea, two U.S. allies with major auto export industries. And there was no additional tariff on automakers, at least, but, Toyota, South Korean car makers as well, were singled out there by the president. Imported vehicles and parts were already covered by that 25% tariff targeting the industry, so no extra charges there. But some of the knock-on effects from the hugely integrated supply chain in car making are very, very difficult to gauge. I mean, even Tesla is not going to be spared by this. A lot of the batteries that Tesla uses has either parts or raw materials that come from the Asia-Pacific. So, the market's going to have an interesting time unpacking all of this idea.
Yeah, and I guess, if you're perhaps a little bit contrarian, there is the argument that based on historical trends that the Topix, should see a rebound after such a big slide, right, particularly when it comes to dip buyers coming back in and maybe buying some of those car makers, but a little bit early to call that yet. But you talked about suppliers, and that's really the aspect that we're watching when it comes to tech hardware and parts providers in Asia as well. Today we had that big move when it comes to Apple stock overnight, the production hubs being hit by tariffs, and that sent the share really plummeting. That supply chain and manufacturing story for Apple when it comes to its centres in China, India, Vietnam, Malaysia, Thailand and Ireland. These tariffs between 20 to 54% is likely to squeeze Apple's margins, could lead to price hikes. Pretty challenging given how shaky consumer sentiment is at the moment and how much of a mixed bag Apple sales have been depending on where we're talking about as well. But with hearing investment strategists saying that semiconductors, consumer electronics, hardware firms in the firing line, exporters also ones to worry about in Asia as well. So the obvious names that we continue to see when it comes to some of these retail distributors that have a presence in Asia, that effective rate for China rising to 54%, and a number of these other markets that manufacture heavily in the region like Vietnam being impacted as well. So a lot to look out for as more major markets come online in the next hour. We're counting down to Asia's major market opens, counting down when it comes to that open in Japan. We're just about 40 seconds away. They're really bracing for this. If the crumbling that we saw in Japanese equity futures is anything to go by, it's going to be an ugly, ugly session, potentially as bad or worse than when we saw the carry trade unwind back in August.
Yeah, absolutely. I mean, this could be the end of Japan's bull market. We've had a number of commentators that we've spoken to today saying this tariff announcement was a lot worse than has been anticipated, and already we've seen gold crack a new record. Yeah, gold, the yen, treasuries. At the moment, we're seeing treasury futures surging at the open. This ongoing demand for haven assets. This is the picture when it comes to just the latest kind of milestone that we're starting to hit there. Japan 10-year yields dropping the most since August 2024 amid these haven beds. And August, of course, was when we had that last unwinding of the carry trade. But this is a picture as we get into the start of trading in Japan. We've also had that outperformance in the yen as well. JGB, Shori, Nikkei futures have just been deteriorating in the kind of opening torrent of how investors in Asia are going to react to these Trump tariffs. We had contracts for the Nikkei sliding more than 6%. JGB future has been gapping higher there as well. And this is a picture as we get into the first a few moments, I should say, of trading there. Steep declines both for the Nikkei and the Topix. We're watching in particular some of those automakers, but really it is a pretty broad-based impact that we're still trying to see how it plays out. Everything from tech hardware providers that affect the likes of Apple in Asia to retailers and their suppliers, manufacturers across Asia as well as Southeast Asia in particular looking to be affected. Dollar yen just under that 148 level. This looks like one of the sort of preferred defensive vehicles that we're seeing for investors at the moment. We could see really that resurgence when it comes to that dollar yen trade, particularly in light of the haven bid, alongside, of course, what we've seen in precious metals as well. Take a look at Korean stocks at the moment because
because we've got a number of sort of sensitivities when it comes to this market. One is, of course, what the outlook is for the chip makers. There's quite a bit of bullishness, actually, when it comes to investors expect greater demand from China, but that's not, of course, on a day like today, perhaps going to be alleviated when it comes to what we're seeing across the broader risk sentiment and just that deterioration that we're seeing. We are also hearing from South Korea's government saying that they'll take all measures to stabilise markets if needed. The South Korean finance minister making these comments at a meeting. We've also had the acting leader, the acting president. They're holding an emergency economic meeting to discuss what he calls a very serious situation on US tariffs.
Well, also in that was completely expected file. Look at the moves that we're seeing in US debt at the moment. Yields falling steeply across the curve. We're seeing a 10 basis point move on pretty much, well, a 5-year, the 10-year down 10 basis points. We're also seeing the US 2-year slipping to 375 at 98 as well. It's funny, the Federal Reserve's Adriana Kugler was speaking at the same time as President Trump was making his tariffs announcement. The intention here to keep rates unchanged until upside risks to inflation abate. Well, who knows when that's going to be. We're seeing some weakness here on the local market in Australia as well, off 1.75%. The Aussie dollar also softening, Heidi.
Well, Paul, here's what President Trump had to say before announcing the 10% levies on all trading partners worldwide. You mentioned Australia, of course, not exempt, but also additional duties on around 60 countries.
In a few moments, I will sign a historic executive order instituting reciprocal tariffs on countries throughout the world. Reciprocal, that means they do it to us and we do it to them. Very simple. Can't get any simpler than that. This is one of the most important days, in my opinion, in American history.
Let's bring our White House reporter, Jennifer Delohy here. Jennifer, great to have you with us. And I think, the severity of the market reaction we're seeing here in Asia really reflects how outsized the impact was on these tariffs on certain Asian countries, right? What did we hear from President Trump, and what is kind of the strategy here? Because it seems like it's not just China, but perhaps the China plus one strategy that's being hit.
Right. They were very transparent. Administration officials and the president himself have been very transparent about, their interest here in really punishing those countries that they see, or leveling the playing field, they would say, with those countries that are, charging tariffs on the U.S. that they see as exorbitant, but also imposing other non-tariff barriers to U.S. goods. They did single out, or they seem to single out a number of Asian countries. Vietnam, obviously, was hit with a 46% rate in today's action, or is being hit with that. And, that's in keeping with what the administration officials say they're particularly concerned about in some Asian countries, which is allegations of transshipment. They essentially a senior administration official told reporters today there's a concern about, Chinese goods going to Vietnam and being reassembled or packaged there and then being shipped to the U.S. A kind of tariff evasion that they are trying to pinpoint here and get at.
Another of Trump's remarks was that the U.S. imports too many electronics, but bringing these sorts of industries home, it's going to take time. Then there's questions around cost effectiveness as well. What's to say that the U.S. consumer doesn't just end up bearing the cost of all of this?
I think that's part of the risk proposition here, right? The administration, the president has said very clearly there will be pain, and part of that pain may in fact be Americans choosing to pay essentially a premium for foreign goods because they can't get those in the U.S. or they're not readily available. They will also be higher priced in the U.S., competing with these foreign inputs that are, these foreign imports that are higher priced. The concern that the administration has been hearing from a number of industries is we can come to America, we can invest and move supply chains, but it can't happen overnight. The administration's response, the president's response today is come faster, and essentially showing a lot of really a limited in sympathy for that kind of argument.
And sort of bravado when it comes to the expectations of how well the U.S. consumer, household and the broader economy driven by those factors is going to hold up, right? Was there any kind of element that negotiations or concessions might be possible? And I guess the question also is, once these tariffs come into place, how easy will it be to unwind them? We've had experts speaking to us saying, you know, tariffs can be very sticky. So even if there is kind of incentive to negotiate, it may not play out the way that the president thinks that it's going to.
I mean, we certainly saw that with Trump's his first term tariffs. They were sticky, particularly on China. President Biden came in and he didn't unwind all of those Trump tariffs. So that, is kind of a baseline expectation here. What we are hearing from the administration is that the 10% baseline rate is designed to prevent cheating, designed to create the integrity or build integrity around the system. So it's hard to see a pathway for countries to get away from a 10% rate, baseline rate that the administration here believes is essential to prevent cheating. On the reciprocal rates, the administration has had a number of inquiries from other countries trying to pre-negotiate. There is clearly an effort to negotiate. I will say one senior administration official told reporters today, this is not a negotiation. This is a national security issue. So there is reluctance even within this administration to really entertaining that. That may also be a counter to anyone thinking there's going to be a lot of carve-outs or dial-downs, certainly anytime quickly.
Bloomberg White House reporter Jennifer Delohi there. Let's take a look at the extent of the decline that we're seeing when it comes to just the first 7.5 minutes of trading in Japan. This is a picture when it comes to the Topix and the Nikkei. Every sector there in the red. We're seeing the steepest declines coming from energy so far, materials, utilities, real estate, but really even the best performing consumer staples group is down by over 1.5% at this point. Let's bring in Sean Darby, who's the managing director of Mizuho Securities. And Sean, on the other end of the spectrum, we're seeing that classic safe haven trifecta of treasuries and other sovereign bonds, yen and gold outperforming. Is this the new normal? Is this sort of the expected reaction that you were thinking we'd have?
Absolutely not. I think the markets had felt that this would be a very short war and that we would find ourselves back very quickly at the negotiating table. But I think what Mr. Trump demonstrated was that there's a formula to how they've calculated these tariffs, and it includes a number of variables, not just the perception of how much other countries have put tariffs against the US, but also the exchange rates, the undervaluation of exchange rates. So there's a lot more complicated task of getting out of this, and I think we're going for a much, much longer drawn-out period in which markets are going to have to recalibrate their perception of global growth and global trading partners as well. I would just highlight to you that also global volatility probably has to move up now quite significantly. Equity volatility has been compressed for years during the disinflation booms of the last 2 decades. And this is another area that's going to have to be recalibrated. So I think from investment point of view, the news over the last couple of hours has not been necessarily what people had anticipated, and certainly not been positioned for either.
We have seen the VIX running hot in the overnight session, so I suspect that could be here to stay. But at the moment, it looks like markets sort of, de-risk first and work out the rest later, right? How would you be positioning at this point? Just really, truly trying to stay on the sidelines and watching to see how this plays out in the next few days and weeks and potentially months?
Well, I think of the countries that one can glance over on the list, I think Australia, New Zealand and Singapore have actually come out relatively well. So I would expect those markets to be relative outperformers. I would assume that exchange rates that are very undervalued, like the Taiwanese dollar, Malaysian ringgit, Japanese yen, they would get a bid because part of the negotiations is to get their exchange rates to be more realistically priced. I think we would also assume that inflation rates are going to be higher for longer. That would tend to mean that it's quite a good environment for the insurance companies because long end rates remain much stickier. And And as I've said, I think vol across the board, whether it's bond, FX or equity, is going to also move up. I think there's a considerable amount of change in the whole economic structure of the global economy that people really are not going to be able to assess until maybe 3 to 6 months down the road. And one last thing just to point out is that President Trump himself has highlighted the fact that a large amount of the revenues from these tariffs is going to be set against the Tax Cuts and Jobs Act, getting that renewed. And therefore, there is a playbook for Mr. Trump in his timeline to get that deal done before the midterm elections. So there's a sense of urgency from the Trump administration to make sure that they're on track in terms of getting revenues from the tariffs to demonstrate that they can get the TCJA passed in time.
Sean, we're coming up on earnings season in the United States as well, and obviously the impact of what we've seen today won't be reflected in the previous quarter, but it's going to be kind of interesting to see and read the outlook on forthcoming quarters. How do you anticipate this affecting the profitability of U.S. companies?
That's a very good point. So you're entirely right. In fact, if you look at surveys like the Beige Book in February, surveys that have come out recently, they've either they missed any news on the tariffs and the implications as the Beige Book did, or they've begun to show that there's been some big changes in terms of inflation expectations. I think the earnings season's pretty much molded in terms of the results, but for the sectors that we would be considered to be most at risk, that certainly has to be the auto sector, consumer discretionary, and I guess also that you would actually start to also think about the condition of employment, because these reciprocal tariffs are going to marginalize a lot of domestic industries in the US simply by the implications of higher costs, which would be some of the parts of the industrial complex. So by and largely, I think guidance is going to come down quite significantly. And I would, on the assumptions that people had somewhere between 12 to 13% earnings growth embedded for the S&P for this year, those numbers could easily drop below 10%. And certainly for some sectors, we would, have to anticipate almost no negligible growth at all. And I would assume that's part of the consumer discretionary complex, which consists of a lot of the auto sector as well.
A lot of the commentary we've had today and around this more broadly has been about the risk of recession in the US, potentially elsewhere as well. When you're looking around to hedge against that risk, I mean, Goldman's picked the yen as its top hedge. Do you like that? What else are you looking at for protection?
Well, I think the fact that the only asset class that has consistently outperformed since Donald Trump won the election has been gold. And gold is telling you that the world is recalibrating in a much, much bigger structure than perhaps we were all anticipating. So if I had to choose one asset class, it would be the gold mining stocks. These gold miners have massively underperformed the gold price, and they themselves, I think, are probably the best hedge in terms of uncertainty and the inflation risks that are certainly going to start to come into people's view in the next 3 to 6 months.
All right, Sean Darby, Managing Director at Mizuho Securities. Thanks so much for joining us. Right, a lot of movers to take a look at today, among them Asian chip makers. Well, the picture tells the story, doesn't it? It's been a pretty good year for the likes of Samsung Electronics and SK Hynix so far, but seeing some pretty heavy selling today. Those stocks off 2.5%, 4.3% respectively, Haidi.
Worries prevailing when it comes to Japanese automakers as well, right, from the impact of these auto tariffs. BI, Bloomberg Intelligence, I should say, looking at the hardest hit being the likes of Nissan, Mazda and Subaru versus some of their peers in that space. You're seeing Toyota, in fact, most of those names down by over 5%. Subaru, they're off by 6.25%.
And Japan's banks, let's take a look at how they're doing. The expectation would be that they'll be heading south as well, and they are indeed. Mizuho Financial off by about 7.3%. And we did hear from Mizuho a little earlier warning about the risks from these tariff announcements. Okay, we've got more ahead on the Asia trade. This is Bloomberg.
China, 67%. That's tariffs charged to the USA, including currency manipulation and trade barriers. So we're going to be charging a discounted reciprocal tariff of 34%. I think, in other words, they charge us, we charge them.
President Trump, they're announcing a 34% reciprocal tariff on China on top of the 20% already being charged for its exports to the US. So let's get more from our Chief North Asia correspondent, Stephen Engel. It's cumulatively starting to look like a quite significant burden, right? What's the sort of assessment in terms of how surprising that was? And I do wonder what the response from Beijing might be.
Yeah, it was more severe than some of the worst case scenarios that were put up forward even by our Bloomberg Economics. So 54 cumulative percent tariff obviously is going to hit the Chinese economy. And also keep in mind as well, this is kind of a China plus one, not only hitting multinational companies like Apple and others who have diversified their production bases to places like India and Vietnam, but Chinese exporters too have diversified their manufacturing bases. Japanese companies have diversified. South Korea has diversified through Southeast Asia. And who got the biggest hits on the Trump tariffs? Well, India, Vietnam, Malaysia, Thailand, Taiwan, and others, including China. So this really is a seismic shift in globalization, if you want to go that far. And essentially, 54% tariffs is something that will probably elicit quite a sharp rebuke from Beijing when it finally gets its narrative out. We've had some commentary already this morning from Xinhua news agency saying Washington's tariff rampage is self-defeating bullying. It says turning trade into an oversimplistic tit-for-tat. Washington, its trade policies are built on a flawed premise and is blatantly ignoring economic realities. We've also seen a story based on sources telling Bloomberg News that the National Development and Reform Commission, the NDRC, the top planning body in China, is starting to allegedly instruct its companies from Chinese companies from withholding investment into the United States. So now we have to really start seeing what are the levers of retaliation, China's reciprocal measures that could potentially come out as early as this morning and then potentially rolled out. What will they do with the yuan fixing and allow the yuan to depreciate like they did in the first trade war? It depreciated 11% over 2 years in the first term of Donald Trump, but they've kept it fairly stable because of their own domestic problems in China, obviously. They are building up domestic consumption in China, but the big question is, where are those end markets going to be if the United States essentially is going to be imposing a 54% tariff? We could see dramatic drop-off, obviously, with this China plus one tariff increase on Asian economies, a dramatic drop-off in global trade across the Pacific Ocean. So that's just the beginning. I have so much to unpack, obviously.
Yeah, it is going to be fascinating to see the response out of Beijing. But we've also got a little bit more detail on the USTR report into China. What more have we learned there?
Well, I think Donald Trump's administration used that USTR report as a basis for justifying that 34% increase on tariffs. Keep in mind, the first 20% that add up to 54% was on the fentanyl issue. This 34%, as we heard Donald Trump talk about China having excess of 60% tariffs on the United States goods. That's not actually true. What they've dug down deeper into were tax breaks, value-added tax breaks, rebates the Chinese government gives to exporters, and other non-tariff barriers that the Trump administration's calculus leads up to more than 60% tariff on U.S. and barriers of entry. So that's why they justified that 54%. In that USTR report, which was due on Donald Trump's desk on April 1st, said China fell far short of implementing its commitments to purchase U.S. goods and services. That, according to the Phase 1 trade deal. So I'm sure Donald Trump used this USTR report, which was nearly 400 pages. The China section was quite long. I didn't have enough time this morning to read it all, but that's the nuts and bolts of it. They probably used that to essentially justify this worst-case scenario on China as far as a cumulative 54% tariff. Now we have to see going forward, does China keep this calm policy? Xi Jinping instructed agencies and officials to remain calm until they got to see the number. They're waking up this morning, if they were not up all night like I was, watching this press conference, they are probably readying some pretty sharp rebuke.
All right, Chief North Asia Correspondent Stephen Engel there. Well, President Trump's sweeping tariff measures will raise the cost of trillions of dollars in goods shipped annually to the United States. Most economists predict American consumers will be among the hardest hit as a result. Bloomberg's chief U.S. economist Anna Wong joins us now for more. So, Anna, tell us what the modelling says about what the pass-on effect for the U.S. consumer is going to be.
Yeah, so first of all, I think there is a lot of confusion about the tariff unveiling today. The tariff level on Chinese goods should be 67%. The 54% is additional on top of the 13% tariff rate before Trump took office. So basically, today's announcement brought the total U.S. effective tariffs to over 20%, and on the tariffs against Chinese goods at 67%. Basically, Trump has fulfilled his promise on the campaign trails. In terms of how it affects consumer, so far, using a Fed model from 2018, that would suggest a GDP hit from these tariff shocks of about 2.3%. And most of this hit on the U.S. GDP will happen in the first year. In terms of inflation, the same model thinks that inflation will go up by 1.5% in total, with about 1 percentage point happening this year. I mean, I think for the U.S. economy, the key is how will the Fed respond to these tariffs? And in these Fed models, tariffs enter as a transitory shock, so all the inflation happened in the first year, and in the second year, nothing changed. In the third year, it became a deflationary shock. And so these models would suggest that the Fed should look through the tariff increase and continue to cut 50 bips as they have signaled in the SEP. But I think, in truth, the Fed will likely take a middle ground where they won't cut as much as they previously intended, but they will continue to cut. So I think our baseline has now moved to only 125 basis point cut by the Fed. But still, the unemployment rate, all these tariffs will be absorbed in the unemployment rate, I think. And the unemployment rate is on track to hit possibly 4.8% in the U.S. by the end of this year, and possibly up to 5% next year.
Anna, how resilient is the US consumer and household, right? Because just looking at the really micro examples of a toy that might be $30 at the moment, by Christmas, it's likely to be $40 or $45. Can households kind of withstand that at this point?
You know, interestingly, when we look at the actual inflation data in the past 3 months, because the front running of U.S. firms and many U.S. firms have been buying Chinese goods in anticipation of these tariffs. So those toys, apparel, furniture, stuff that we tend to buy from China actually has experienced a sharper disinflation or deflation than other goods that are not imported from China. It's very unintuitive, and I think part of it could be that the elasticity for demand of Chinese goods is greater than one. So the consumer in U.S. right now is experiencing a very deleterious drop in sentiment. It could be that they're pulling back on these discretionary consumer items like the ones that they bought from China, like toys and furnishings. So far, we have not seen an sharp increase in inflation on goods that we buy from China.
Yeah, that pricing strategy and the elasticity of consumer demand is a really interesting aspect of how this could play out, right? Anna Wong is our Bloomberg Economics chief U.S. economist. Let's take a look at how futures are opening up in Europe, because, of course, other than Asia, the hardest hit were really these European markets from the Trump tariff announcement. This is a picture as we see continuing the downside that we are, of course, witnessing in the sell-off here in Asia. We're seeing another down day when it comes to European equities. A previous session, we saw some pretty mild declines awaiting awaiting President Trump's announcements of those tariffs. We saw healthcare leading those declines, but we do expect to see sort of a broader-based sell-off in the session. Bonds, though, could catch a bid given what we've seen when it comes to JGBs, Aussie, New Zealand bonds, and that rally, of course, in Treasuries with the Haven bid prevailing. More ahead on the Asia trade. This is Bloomberg. We'll take a...
Okay, we're just getting some breaking news out of Australia. It is, hey, it's trade numbers for the month of February, though, so who cares? 2.9 billion.
How relevant.
Yeah, exactly. Look, it's a big miss, though. 2.9 billion Aussie dollars for the month of February. The market was expecting much more, 5.4 billion. Exports sinking at 3.6% in the period, while imports picked up 1.6%. That would please President Trump, except Australia does indeed ban US beef from Australian markets. Now, this is nothing at all to do with tariffs. This ban has been in place for more than 20 years now due to concerns about mad cow disease. And anyone who's ever visited Australia will know that biosecurity laws are very, very tough. President Trump has complained about this. Anthony Albanese, though, saying, the Prime Minister, that biosecurity is not up for negotiation. So Australia not willing to budge on that ban on US beef. Australia did, of course, get that 10% baseline tariff. Australia's also got a free trade agreement with the United States, which is the country's fourth largest trading partner. Trade between US and Australia worth $49 billion in 2023. That is only about a quarter of the value of the trade between Australia and China.
You know what we're hearing from the RBA in the Financial Stability Review, pointing out that US tariffs and the response to that could have a, quote, chilling effect on activity. And, you know, some of the activity that we could see really showing the lacks of that chilling sort of effect will be these regional PMIs, right? Take a look at what we're seeing in terms of the March numbers. Jibun Bank Japan March Services PMI coming just on that line of 50. Composite PMI under that 50 level, 48.9 when it comes to that contraction. We're also looking at some of the gauges when it comes to Hong Kong, both of the continuing to stay and actually deteriorating further into contraction territory. Singapore actually bouncing up a little, but of course Singapore also being hit with that baseline, what President Trump calls a baseline level of tariffs as well, and of course a very externally exposed economy there. So we'll be watching those numbers very keenly in the months to come. Take a look at markets at the moment. We've got that classic risk-off sell-off, and what a sell-off it is, and how much of that is actually flowing into one of the biggest beneficiaries of this trade, which has been the yen. We're seeing 148.26 is where the yen is at the moment, but it did gain by over 1% against the dollar. This is the biggest gain since I think about February 20th. We've also seen Japanese bonds rallying alongside treasuries, Australian bonds there as well. Dollar China is one to watch as well when it comes to just pushing against the comfort levels of the PBOC. So that yuan fixing is one to watch today. Let's bring in Bloomberg FX and rate strategist Michael Wilson joins us now. So in retrospect, it felt like the past few days have been really the calm before the storm, right? What do you want to start off with in terms of what's really jumping out at you across FX markets? The yen?
I think the yen is in the crosshairs. You know, they got their medicine just like everybody else did. But the way the market is shaping up, they're looking, you know, if this is going to be the status quo in the short to medium term, then the Japanese curve, I know that JGB's rallied today on a risk-off price action, but overall, that's going to those tariffs are going to feed into the Japanese inflation outlook, and it's going to maybe even bring forward a potential Bank of Japan hike. You know, I say that that's probably at the margins, probably going a little bit over the top, but you know they are torn between either growth or you know, getting inflation in line, and you know, once it starts to show up in the data, I think they'll be compelled to act. So you know, just and globally, you know, the whole data reset is going to have to occur. You're going to have pre-tariff, post-tariff, and all that sort of mumble, because you know, this is all a whole new ball game, and you know, for the Japanese yen now, you know, I think that it's particularly, you know, maybe against the dollar, it might be a little bit too volatile, but there's some real strong themes playing out in, say, yen against the Aussie, Australian dollar. You know, we've got a prolonged halt by the RBA. And, against the yen, I think it might not be too much of a match. And I think we can see Aussie yen go down towards 90 just while this, current situation finds some sort of level playing field. And just on that, Australia's response is pretty timid. And I think that's what we're the very next stage. We're looking at the European response for Euro yen. And, the UK's, they only got a 10% tariff, like the baseline, but then their trading partner Europe, they're trying to sort themselves out, just in the same way China's trying to sort itself out. Which is going to affect Australia. So if we're going to have to wait a little while for the impact to flow through into the Japanese data and globally for that matter. So how much weight we put on non-farm payroll data, in the interim is probably a very, very short-term play. But the whole situation is still the ink's very wet still, and I think that Trump has left himself a little bit of room for negotiation. He's certainly left that on the table if countries want to approach them and try and mitigate their circumstances a little bit.
Mike, how about the outlook for emerging Asia foreign exchange as well? Because, we're on watch now for record lows for the offshore yuan, for the Korean won as well, and particularly some of those Southeast Asian nations that fall into that China +1 category.
Yeah, I really sympathise with those countries and the currencies for that matter, because, look at a country like Indonesia. They were already dealing with Chinese imports. I think we wrote about it a couple of weeks ago, where China's trying to offset, or try and complement their own economy wherever they can, whenever they can. And so they were already contending with cheap Chinese imports, and now they've got this tariff around their neck. I do think that we're going to see new lows for, Repire and pretty much every Southeast Asia. I can't see, I wouldn't want to pick a dip in the next 2 weeks. I think there'll be plenty of overshoot. And then there's the issue of liquidity. These central banks say that they've got some firepower, but not anything like the big ones. So they might have to let it run a bit before they try and step in. Otherwise, they're just going to throw good money after bad. But again, like Indonesia, a good case in point. And I think for the offshore yuan, I think they got up to 737.50 last time. They've got to expect a new high there. So I'd probably keep an eye on the fixings, the daily fixings, just to get a little bit of insight what the PBOC's thinking, whether they do a weak fix for the yuan. Just there's no use trying to fix it strong if it's just going to get run over. So I think that's what they're what traders will be looking at in the interim. Why still eyeballing that low 737.49, I think, in the last few months.
All right, Bloomberg's Mike Wilson there. Let's take a look at some of the stocks that we're watching, particularly banks in Japan. They're all sinking quite heavily. That's perhaps been hit by hopes that rate hikes by the Bank of Japan was going to boost lenders' earnings. Mike said that perhaps early tightening from the BOJ might be on the cards. Seems a little bit unlikely, though, as he mentioned. But we're seeing bank stocks in Japan getting hit pretty hard at the moment. Most of the big names off by more than 5%. Well, many Southeast Asian nations, as we mentioned, are high on Trump's tariff target list. Key among them, Vietnam, an ETF that tracks Vietnam's MVIS index plunging in the US post-market. Bloomberg's Avril Hong is here with more. So, Avril, these tariffs worse than expected for Vietnam and some others.
We had some pretty strong comments from him overnight.
Absolutely. I think if you look at Trump's chart, right, you see some of these Southeast Asian countries really high on the list, and chief among them is Vietnam, 46% in terms of levies. And you look at the market reaction in terms of the ETF in the U.S. post-market, it just tells you how markets weren't really positioned for this. Maybe they were holding out hope that it wouldn't be as bad as expected. Maybe we see today investors picking up some value, domestic defense-related stocks, but for now it's going to be a really bearish mood, I think, across equities. It's going to be a case of liquidation potentially and sell first, ask questions later. We're going to keep an eye on the Southeast Asia stock gauge from MSCI, and that could breach not only the March lows but also hit the lowest levels in 8 months. We're expecting pressure as well on the currencies. We have seen, really this logic that tariffs are being used to address these trade imbalances. So perhaps using that is not surprising that we see how some of these Southeast Asian countries are getting hard hit, because a lot of them have huge trade surpluses with the US. Top 15 indeed include the likes of Vietnam, Thailand, India also kind of featuring on that list, and Singapore, which actually has a trade deficit with the US. So going by that logic, perhaps unsurprisingly, 10% in terms of levies. Now, keep in mind as well that this kind of tells us that Vietnam's last-ditch efforts in terms of its charm offensive, this flurry of diplomatic activity, pledges to buy more big-ticket U.S. items, as well as to slash tariffs, which, by the way, is also a playbook that India has sort of taken and used, deployed. We just know from this current levels of tariffs that these efforts just have not worked.
Vietnam's exports are equivalent to about 85% of GDP, and I do wonder how these nations like Vietnam are going to be able to navigate this.
Yeah, I think it's going to be quite difficult, not just for Vietnam, but for the rest of the region in Southeast Asia. They're kind of being hit by these double whammies, right? Not just are they seeing high levels of tariffs from the US, but also one of the key trading partners, China, getting hard hit. So it's this idea of this global upending of trade for Vietnam in particular. As you rightly pointed out, it's really reliant on trade. Exports account for about 85% of its GDP, and it has a really ambitious goal of 8% growth for the year. So this, if we take these tariffs going into effect, is going to be a huge dent. Really big questions of whether it's going to be able to reach these goals. And I imagine that this would also be a real headache for some of these companies that have shifted production out of China into Vietnam, going by the China Plus One strategy. I mean, if you look at these levies, it's even higher now for Vietnam than it is for China. And, I think our colleagues at Bloomberg Economics also put out a really good note. If you take these tariffs at face value, you look at the median rate for the region, 36% for levies. So they think that the impact from the US trade shock could be even worse than the 2008-2009 GFC crisis. And this time around, the difference is that China is not quite in a position to kind of provide a sort of buffer. We might see some of these domestic-driven economies like Indonesia, Philippines, maybe doing a bit better. But overall, our BE colleagues think that the chances of these central bank cuts in the region are higher than before Trump came to office.
Avril there with the details in terms of how this China Plus One strategy seems to be targeted by the Trump administration in these tariffs. More ahead on the Asia trade, this is Bloomberg.
Let's take a look at how tech shares are tracking in Japan at the moment. Not particularly well, along with everything else. Tokyo Electron are leading the losses at the moment, off by 5%. Nintendo is an interesting one, lower by 2.25%. Nintendo did, of course, announce its new Switch 2 console amid all the noise, but that's been somewhat swept up in this broader conversation around trade and tariffs from the United States. Well, as I mentioned, President Trump has announced 24% tariffs on Japan, 25% on South Korea. These are two of the US's closest trading partners. Well, let's get some more perspective on the impact of these markets. And we're going to talk about Nintendo in a moment as well. We're joined now by Kazunori Ito, Director of Equity Research at Morningstar. Kazunori, how sustained do you expect to see these moves in Japanese and Korean tech stocks to be?
Yeah, as we have been talking, the Japan is one of the export companies. So, we have to assess how the tariff issue will impact the short-term profitability of the exporters. Also, the long-term, in terms of the longer term, the tariffs may cool down the end demand. So, we need to assess how that will impact. So, giving the numbers, like among the companies I cover, like roughly speaking, the U.S. market accounts for like 25 to 30% of the PC shipments, and like 35 to 40% of the game console shipments, and like 15% of the mobile shipments. So obviously there will be the worldwide impact to the tech industry.
To what degree do you expect these Asian chip makers and tech companies to absorb the cost of this tariff, or is this just going to get passed on in its entirety?
Yeah, I think the impact is too huge and not able to like offset all of the tariff impact. So obviously, some of the cost increase will be passed over to the end pricing.
When you take a look at specific companies, and obviously Nintendo is in focus today with the new product reveal, but where do you see the biggest impact in terms of having that exposure to the US market?
Well, my coverage, I'm not the strategist, but I cover the consumer electronics companies. So obviously, the consumer electronics companies, will be the one of the having the biggest impact. So on the other hand, I would probably say that the game developers should be less impacted from the tariffs because, like, more than 50% of Switch games are sold online, and more than 70% of the PlayStation games are sold online as well. So it should be not relatively less impacted by the tariffs.
Where are you seeing the biggest markets for a company like Nintendo now?
I'm sorry, what's the question?
Where are you seeing the most important markets for a company like Nintendo or for some of the other gaming related stocks?
Yeah, the U.S. is obviously the largest market. So as I just mentioned, like it will. For the game console shipment, like the U.S. is the largest market, so accounting for 35-40% of the console shipments. Again, like the U.S. accounts for like 25-30% of the PC shipments. So I think these are the two like the biggest areas under the consumer electronics field affected by the tariffs.
Well, let's talk about Nintendo's new Switch console. Such an unfortunate day to be announcing this. It's been overshadowed by the announcements from the White House.
Unfortunately.
But what have we got? Well, there's a bigger, more vibrant screen, chat and social functions. It's pretty pricey, though, at US $450, and maybe even more so when we consider the tariff. So how well do you expect this to sell when it does launch in June? And what's it going to mean for Nintendo's bottom line?
Just apart from the tariff issue, I think, the Nintendo's announcement was quite positive with the three major positive surprises. So that can raise the expectations for the console shipment and also contribute to the expanding the user base. So the first surprise was the social functions, including the voice chat and screen sharing features. I think that will make the new console a more personal console, and that will provide a strong incentive to buy more than one console per household. And probably the second surprise is the very rich and strong launch titles from the third-party game developers. So when the new console is launched, it usually takes like 2 or 3 years for the third-party game developers to get used to the platform. But unlike the past, Switch 2 is a promising and attractive platform. So many like the game developers decided to launch attractive games from day one, and that is quite unusual. So the launch titles from the third-party developers were quite attractive. So that would help motivating users to purchase Switch 2 console. And the last, the surprise was the pricing, as you just mentioned. So I think $450 price point is quite competitive, and especially in Japan, there is a price difference between the PlayStation 5 console. So in the Japanese-only version was priced at 50,000 Japanese yen, which is much lower than PlayStation 5's 73,000 Japanese yen. So the pricing seems to be competitive. So for these three reasons, I thought that the Nintendo's announcement last night was successful.
Kazunori, really great to have you with us. Kazunori Ito, who's a Director of Equity Research at Morningstar. More ahead on the Asia trade. This is Bloomberg. Take a look at how we're setting up, particularly as we head into the start of trading in Taiwan and across Greater China there. Looking like that downside that we're already seeing, the steep sell-off across Asia will be set to continue, particularly as investors in China pass the 54% tariffs that have been applied to Beijing. We're also watching the PBOC fixing today as well. The currency sitting near that February low, so that guidance from the central bank will be key. Let's bring our China correspondent Min Min Lo in Hong Kong. So we're already seeing that pretty steep reaction in markets that are trading at the moment. What are the expectations as we get into trading in Hong Kong and in the mainland today?
Yeah, it's going to be an ugly day for markets because the tariffs announced 37% in reciprocal tariffs plus the existing 20% that are already in place. That brings the total to 54%. That is pretty much very close to the worst case scenario that people have been planning for and very close to what Trump had pledged in the campaign trail, the 60% tariff. And so we saw in the after hours, you look at some of the tech stocks in particular, Alibaba, JD.com, PDD, a big slump there to the tune of about 5%. That's also because Trump had announced that the end of this de minimis loophole for small parcels that would have been exempted from these tariffs. And you can see TSMC as well down about 6% because Taiwan as well got about 32% in the reciprocal tariffs. You look at the KWEB, that's also down to the extent of about 5%. China futures pointing down as well. But of course, the biggest move that we see is in the Chinese yuan. Last I checked, it was down about 0.4% against the greenback. And this is close to the about 0.2% away from the record low when it comes to the yuan. And we are also trading above the daily limit yesterday. So we'll be watching the fix today very closely, whether the PBOC would continue to defend the yuan or whether it will shift that goalpost when it comes to dollar yuan. And investors will also be looking at what sort of support from the government, whether the national team will be stepping in to buy directly into some of the ETFs.
Yeah, in that respect, I mean, China would have seen something like this coming and no doubt has prepared. What can we anticipate in terms of potential announcements or action from the national team, as you mentioned?
Well, we'll have to see whether, we have messages of support from the PBOC, whether they will be looking to cut rates imminently, for example. But in terms of countermeasures, just judging from previous experience, China tends to respond only when the tariffs kick in. And this time it would be on April 9th, midnight U.S. time. We could hear some statements from the Chinese Foreign Ministry later this afternoon. And already we got some editorials from Chinese state media as well. The latest was published this morning by Xinhua saying that this tariff rampage is a self-defeating bullying. And here you go. That's another editorial saying that it will all backfire on the U.S. economy, talking about how there could be higher risk of inflation, recession, unemployment. And we'll have to see how China would respond to these tariffs with concrete measures in the coming days.
All right, Bloomberg's China correspondent Min Min Lo. Markets in China and Hong Kong opening at the bottom of the hour. Not Taiwan, though, closed for a holiday. China show coming up next. This is Bloomberg.